we're going to have one of those moments again where we look into the abyss and think, my goodness, how on earth are we going to get out of this? I just cannot see how we can escape this. What do I do to protect myself? And I think at that stage, you'll probably find that markets will close. You won't be able to do anything. I suspect they will also close gold and silver markets, both futures and forwards, and also they will probably try and close the physical market as well, until some sort of order is restored.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're always honored to have this distinguished returning guest. Alasdair MacLeod is the head of research at goldmoney.com. He's also a former bank director with extensive research that he does every week and tweets about it every day about the global financial system and the state that we find ourselves in of increasing concern. Alasdair, thank you for joining us again this Wednesday, June 15, 2022.
That's my pleasure, DK.
This is a very eventful week. Today is the Federal Reserve's Open Market Committee meeting where they're going to be announcing their action on interest rates in the U.S. But yesterday and the days preceding it have been very eventful as well, leading up to what was described by Gregor Mannarino as a apparent instability in the debt market, with the runaway interest rate on the U.S. benchmark 10-year Treasury note increasing up into the mid 3+%. And then, interestingly enough, overnight last night, some large entity with deep pockets stepped up and bought enough bonds to pull that benchmark down by 11 basis points, which is a significant move, and perhaps has injected some relative calm in the markets versus the growing sort of smoldering panic that was happening yesterday. The question I'd like to break open with you or help today is basically, can the central banks keep us from this train wreck, or are we too far gone? And is it just a matter of these things playing out faster or slower, depending what gesticulations they do? And I'll open that to you. And first of all, if maybe you can clue us in on how much of the current concern that people were having about the potential instability in the debt market you feel is real, whether you think it's limited to the U.S. or also shared by the ECB and others, and we'll take it from there.
Well, the problem is real, and it's real in every jurisdiction. You've only got to look at the official rate of consumer price inflation and the level of Fed funds rate, or the ECB's deposit rate, which is still minus 0.5%, or the Bank of Japan's policies, which are still negative in terms of interest rates. And you can see that the central banks have been badly caught. As to the point as to whether they can rescue the system, I fear not. You may have noticed that I think it was about 2 weeks ago, the Fed announced that the unrealized losses on its holdings of US Treasuries and agency debt were $330 billion. Now that compares with the Fed's balance sheet equity of $50 billion. So that is wiped out on those figures 6 times over. Now that was March. Since then, yields have risen further. And I estimate that today, the Fed is likely to be in the hole for $500 billion, $500 billion. In other words, it is technically bust without it being refinanced. Now, the Fed can refinance itself. It can refinance itself very, very simply. And it does that by lending money to the federal government, and the federal government applying those funds back onto the Fed's balance sheet, not in the form of a deposit, but in the form of equity. So, problem solved. But you don't want to have to do this in the middle of a crisis. It's really not the best thing to do. The problem is far more acute elsewhere, and I particularly refer to the position of the ECB and the Bank of Japan. We have seen both the euro and the yen collapse in value against the dollar in recent weeks, and there are very good reasons for this. If we look at the yen, the Bank of Japan has tried to draw a line on rising yields, insisting that the yield on the 10-year JGB must not rise above 0.25%. 0.25%. And we've got raging inflation around the world, raging inflation measured by CPI. They are clearly drawing a line in the sand, which means that they will sacrifice their currency. And this is why the yen has been collapsing. Furthermore, the Japanese banks are very highly leveraged. The asset to equity ratio is absolutely staggering. I mean, I've got the figures here because I've been writing about this for an article to be published tomorrow. Mitsui, asset to equity ratio, 62 times. Can you believe that?
Wow. I remember you were talking to us 20 to 30 times just a few months ago, and that was concerning to you.
That was concerning. And Sumitomo Mitsui, 48 times. And Mitsubishi UFJ, 40 times. Those are the three global systemically important banks in Japan. So what happens with rising interest rates? Well, obviously, their balance sheets get decimated because on a mark-to-market basis, then their assets are going down insofar as they are invested in bonds. Now, the point worth making is that not just the Japanese G-SIBs, but everyone else's G-SIBs are primarily invested not in loans to industry, but in financial assets and loans to other people who use the credit to buy financial assets. So you've got this huge, great pyramid, and the collapse is mainly in the financial markets, with financial assets going down the tubes. And we've seen how this is beginning today. So when you look at asset to equity ratios of 60 times, just think how little in terms of non-performing loans and how little in terms of falling asset values will wipe that out. Very little.
So just let me just try this on the sake of from the cheap seats here. If you have a 60 to 1 ratio of your capitalization and your assets go against you by about 1.6%, then you're basically insolvent. Is that the idea?
That is correct.
Wow.
Yeah, you've got it. And the central bank, the Bank of Japan, has been doing QE since the year 2000. It is now heavily underwater on any valuation of JGBs, and also it's got a substantial amount or a significant amount of ETFs holding equities, so it's exposed to a falling equity market. And I estimate that as of last Friday, it is likely that the deficit on its balance sheet exceeds its equity by some 140,000 times. I mean, this is just staggering. It is absolutely impossible. Now, again, the Japanese central bank can recapitalize itself by the means I've just suggested. But again, it better get a move on, because if it's going to be in a position to backstop the Japanese banking system, then it needs that money now. It needs that capital now. And it doesn't want to see any further rise in bond yields. That's what it's trying. That's why it drew the line in the sand at 0.25. Originally, it was at 0. So this is the Japanese central bank is in a very, very serious problem. Now we turn to the ECB. I looked at the ratios of the banks there. Societe Generale, would you believe 76 times assets to equity ratio? Groupe Crédit Agricole, 75 times. Deutsche Bank, 69 times. After that, we get into sort of slightly more or slightly less surreal territory, let me put it that way. We're looking at BNP Paribas, 46, UniCredit, which is the big Italian bank, 44, Santander, the Spanish bank, 36, Ingroup, which is a relatively conservative business, 26 times. These are very serious issues. And they have a difficulty recapitalizing themselves as individual banks, which they can do. They could do the same situation, if you like, as the central banks. But the problem is that all these banks are at price-to-book ratios which are well under 1. I mean, if you look at SocGen, that's a discount of 30% to book value. And Group Crédit Agricole is, that's actually, Group Credit, that's 80% discount. That's even worse. I mean, these figures, how do you raise money in these circumstances? But it also explains why these banks have been buying in their own shares, because on a balance sheet basis, it looks like jolly good value. If you can buy back your equity at 30 cents in the dollar or 30 cents in the euro, then, why not? But the problem is that what that does is it reduces your capital base upon which your balance sheet is based. And this is one of the reasons that some of these banks have become even more highly geared than they were before. And that's certainly true of banks like Barclays. Why the regulators permitted this, I really don't know. I mean, they are asleep on the job is the short answer. Now let's look at the ECB's impossible position, its own impossible position. It is deep underwater, very deep underwater, because it has got a substantial holding of bonds whose prices have fallen quite substantially. I would estimate they've fallen by an average of somewhere between 25 and 30% of face value. This is very, very serious. It really does wipe out substantially. All the equity's gone in the ECB. So how does it recapitalize itself? It doesn't have a government to turn to. Its shareholders are the national central banks. And, surprise, surprise, the national central banks in the Eurozone are all underwater for exactly the same reasons. So they can turn to their individual governments and get financed. And on the back of that, they could probably go and refinance the ECB. But just imagine you're a German member of parliament in the Bundestag. You're looking at the situation saying, hold on a minute. In the Target 2 system, the Bundesbank, which is asking for our authorization to recapitalize itself, is owed 1.2 trillion euros. Tell me, Mr. President of the bank, what are you going to do about this? So you can see that this is actually very difficult. And I would have thought that the federal Supreme Court in Germany would have a few words to say as well about this. So the ECB really is in an impossible position, and it is not in a position to backstop the commercial banks, particularly given that a very small rise in interest rates from here, and possibly already this may have happened, will wipe out their equity and turn them insolvent. You can turn a blind eye, perhaps, for a little bit against this situation. But as interest rates rise further, which they will do because of that relationship between consumer prices rising and in Germany, producer prices, I think the last figure was up 30% on a year, for example. You've got an economy that is collapsing. You're going to get multiple bad debts mounting up now. I mean, and the central bank, the ECB, and the national central banks are not in a position to discharge their function of ensuring that the banking system doesn't fall over. So I would say that the Fed is actually been relatively responsible in this situation insofar as it doesn't seem to have permitted its major G-SIBs to become so insolvent. I mean, the ranking there is considerably less. I haven't got it in front of me, but you're looking at banks with anything between about 8 times assets to equity to, I think City is the worst, something like 20 plus 25, something like that. But the majority of them are in the teens and probably the low teens. So, I mean, that's bad. That cannot weather the sort of storm that we're seeing. But it's not half as bad as it is abroad. And if you're going to try and think, where does this crack? I would have thought that it either cracks in the European Union or the Eurozone rather, or it cracks in Japan. But once it cracks, they'll all start falling over. And that is, I think, of great concern.
That's what I would like to ask you to help us to see how that's related, because many people think, well, as long as the dollar is relatively strong and as long as the United States banking system is relatively healthier than other parts of the world, well, let those chips fall where they may. But when you talk about a crack and that sort of thing, all I can picture is a dam and pulling out the stone that's the keystone. That it doesn't matter that you have a lot of other strong stones somewhere else in the dam. If you pull out the one, it can cause a huge systemic failure. Could you walk us through what are some example mechanisms by which a failure of the Japanese central bank or major commercial bank, significant banks in the Eurozone or something, would have immediate impact, catastrophic impact on the global banking system or on the U.S. in addition?
Well, it's through banking relationships. The whole point about designating a bank a global systemically important bank is actually in the title. There is counterparty risk in these banks, which has the potential to destabilize the whole of the global banking network. And as I've just described, the majority of these banks are so highly leveraged that the slightest accident means that the whole of the global banking system is at risk. And to my mind, the biggest risk is in the ECB because the problems of resolving its lack of capital. Of course, you've also got squabbling governments underlying this who probably can't agree on anything, really, and certainly can't agree on anything in an emergency. So the ECB is a badly designed institution, and it's not really capable of surviving this sort of crisis. There is no way it has the autonomy to turn around and suddenly magic up new capital from nowhere like that and say, we are equipped, we are strong enough to deal with this situation. I mean, I think even today, I haven't really read it, but I saw a headline that the ECB is now trying to work out how to get extra money to the weaker governments. Now, come on, look, the problem is that the ECB has got already these enormous liabilities. And what does it want to do? It hasn't really got any option, but what it's planning to do is to make its position even worse. It does not have an escape from this situation. And if the ECB goes, I think the euro goes. I think the whole of the Eurozone falls apart politically as well as economically. And the effect on the global banking system will be to destabilize that as well. So we're going to have one of those moments again where we look into the abyss and think, my goodness, how on earth are we going to get out of this? I just cannot see how we can escape this. What do I do to protect myself? And I think at that stage, you'll probably find that markets will close. You won't be able to do anything. I suspect they will also close gold and silver markets, both futures and forwards. And also they will probably try and close the physical market as well until some sort of order is restored. And that is something that cannot be done very, very quickly. And I would very much doubt that they would restore order out of this absolute chaos that is now becoming inevitable, absolutely inevitable. And if you look at the European Union or the Eurozone in particular, the economies of the member states are turning down quite sharply. They are exposed to Russia. They are exposed to Ukraine. The banks are exposed to Russia and the Ukraine. And with the German economy turning down, you will also see other economies turning down. Government deficits are going to be rocketing. How does the ECB navigate through all this? I mean, I think the task is far too big for it, and I cannot see a way out.
As people who have been in the minority, maybe at less than 0.5% of most people actually waking up to these risks because we're not being told about these on the mainstream financial press. But for those who have been following this progression of this train wreck in slow motion, or not so slow anymore, and have been trying to position themselves to be less exposed to catastrophic loss and risk than they would be otherwise, and then most people will be. When the time comes of what you're talking about, with major markets locking up and major exchanges being closed and that sort of thing, if people are thinking, well, I'll wait until I'm sure, or I'll as long as the party's going, I'm going to keep my funds in the market. But once things look really grim, then I'll go get my whatever it is, hedge, protection, that sort of thing, physical assets, that sort of thing. It sounds like from what you're saying, you're thinking it may be too late at that point.
They will be too late. It's quite simple. You have to prepare for this, or tough. I'm sorry, but that is what it amounts to. The only thing to do is not to go and buy paper gold, not to go buy ETFs, but you have to have the physical. You have to have coins, which are legal tender. I mean, I don't know what the legal situation is in America, but in this country, we have sovereigns. We also have, I think, virtually any coin produced by the Royal Mint, which has the sovereign's head on it, is legal tender and can be used as money for transactions. So that is important. Also, any silver coin produced by them is legal tender, so that can be used for transactions as well. So that is important. So if you haven't got that when the whole system falls over, then you're not going to get it. I mean, it's as simple as that. Or the only way you will get it subsequently is to make something or to sell something for gold or silver coin. And that's the only way you'll get it. What the authorities will do in this case, I mean, to an extent, it depends how quickly things deteriorate. I'm tempted to think that things will happen in phases, but probably with not a lot of time in between. I think the first thing that we see is a crisis in financial asset values and a banking crisis. The currencies, I don't think, fall over immediately, but you will find that gold and silver will be very, very scarce. And at anything like current prices, it just simply won't be available. If there is any time between the two, then I think what the authorities could well do is they could well try and stop us owning gold and silver, because they would see that as adding to the loss of purchasing power of currencies as people seek alternatives to using fiat currencies. I mean, it's happened before. It happened famously in 1933, and it happened in John Law's France in 1720 to 1721. I mean, basically, they sent the police round, or the troops, to take any gold, silver, jewelry, anything off people to stop them using it as currency, and incidentally to bolster the the currency or the assets, if you like, of John Law's bank, however it went, or even, I suppose, the king's assets. So governments will resort to anything under these circumstances, and we have to be very wary of that situation.
The words you're speaking are chilling, and it reminds me of back at the Declaration of Independence of the United States, where the colonists had felt that they were under just tyranny and usurpation of their natural rights by the leadership, in this case, King George III of England. But it led me back to my question that we started out from: is can the central banks save the day? Can they avert disaster? And my mind is drawn immediately to the question of, well, isn't this a disaster of their own creation, of their own making, by design or by policy, certainly? And are they not responsible to the people, have they ever been responsible to the people, or only preservation of the system, as you said? And I think you mentioned something in our pre-conversation when we were talking about that they've already failed in some major respects. I just wanted to read one quote from the Declaration of Independence. It says, "A history of repeated injuries and usurpations, all having in direct object the establishment of an absolute tyranny over these states," in this case, the United States, the states and colonies of America, but in the people of the world, trying to live their lives, trying to do their good work and save up the fruits of their labors in tangible form that they can use in the future for whatever they freely choose in privately. Have the banks upheld any of those natural rights of people, or have there been these repeated injuries and usurpations, all having direct object the establishment of an absolute tyranny over the people?
Well, central banks are basically appointed by governments, and they may claim that central banks are independent, but they appoint the executive of the central banks, and they're not independent in that sense. So the central banks are a tool of government. And what we see increasingly is that the interests of government are diverging from the interests of its electors. The art of politics is to persuade everybody that you are actually working in the electorate's interests, when in fact you're not. And that is really the situation. So the tyranny under George III, in fact, that it was not quite true. There's a bit of presentation in that, because George III did not take these decisions. The decisions were taken by the government of the day, the British government of the day. So it was them who actually should be accused by the colonists of taking away their rights, taxation without representation, all this sort of stuff, rather than George III. He was the figurehead, if you like. What the central banks are doing is their primary objective actually is to ensure the government is always funded. And that is why they license commercial banks, so that through the process of credit creation and the creation of money, government will always be funded. And that's why when things started to sort of get adrift and government wanted to spend a bit too much money, effectively they've been driven progressively off the gold standard. So the idea that central banks are working in the interests of you and I, forget it. They're actually taking our wealth. I mean, we've talked about the Cantillon effect and so on and so forth before, whereby if you debase a currency, then you're just literally, without any representation whatsoever, taxing the wealth of the nation, and particularly the productive side of the nation. You're just taking it all away for yourself. And that's basically what they're doing. So are they working on behalf of the people? Are they interested in the people? No, certainly not. They're primarily interested in funding the government. And I really think they have no further interest. And all this stuff about, we will target inflation at 2% and we will ensure that it is consistent with full employment. I mean, that's a load of rubbish. The reason behind that is that actually they want to have as much employment so that the government revenue is as high as it can possibly be made. So I don't buy the story that these guys are just literally fallen angels who can get up again and then suddenly realize the errors of their ways and be nice to us. And no, that's absolute rubbish. Not at all.
So where does that leave us in this current train wreck, I call it again? You talked to us earlier saying you'll be surprised if the euro makes it throughout the end of this year. It sounds like the JCB is of grave concern to you presently in the near term, as is the ECB. Are those the areas that you're looking most closely at to see signs of these imminent cracks that you're expecting to see appearing in the financial edifice?
Yes, generally, but I wouldn't like to exclude London from this, because London, being the international centre, also has the potential to destabilise things. And we haven't exactly been if you like, blameless in this. I mean, the level of gearing in Barclays and Standard Chartered is still very, very high. I can't remember what the figures are off the top of my head, but I mean, we're looking at all sort of nearly Japanese levels. HSBC less so. I think they're probably a bit under 30 times. But I mean, this is still ridiculoly high. HSBC has been criticized, and so has Standard & Chartered to a degree, about their links into China. And that has been seen as a risk. And I'm sure that those banks have taken steps to ensure that the liquidity on their balance sheets gives them at least some protection. But nonetheless, if you have to start writing things off, and this is to me, the big mistake in regulation. What the regulators have done is they've concentrated on how the balance sheet is structured rather than looking at the relationship between total assets and equity, which is what any banker looks like when he gets frightened about economic conditions. I mean, all this sort of stuff about, Basel regulations and all the rest of it, it's all about, having liquidity in your funding side, or having it tied up on your funding side, and having loads of liquidity on the asset side. And that way, apparently, according to the Basel regulations, banks are systemically not risky. But it ignores the pressure on the management when they turn from greed to fear, when they stop expanding bank credit, when they see a bear market and they think, we've got to reduce our exposure to the markets. That is where the real risk comes from. And it seems to me that none of the regulators have actually taken this point on board.
And again, these numbers, I'm trying to relate this to something that people can understand. When these banks are heavily loaned into, say, commercial businesses, commercial real estate, other major loans that they have out as assets, they consider those to be assets. And then if those assets become non-performing because those businesses go bust, or the equity markets turn down. We've had anywhere from 15 to 30% downturn in the major markets over the past, just since the beginning of this year. But if these banks are leveraged 20 to 1, 30 to 1, 40 to 1 up, then it sounds like only a few percent of losses on their asset side makes them insolvent. Can you help people understand what that means? So what, can the bank just snap its fingers and recapitalize itself somehow? Or what's the magic trick that gets that to not be the start of a huge catastrophe?
Okay, well, there's several aspects to that question. I'll deal with the capitalization first. When the shares are at a substantial discount to their nominal value, in most jurisdictions, I think probably in all jurisdictions, under those circumstances, they cannot issue more shares. Now, the way this is got round is that you have a nominal share value which is close to zero, if you like, so you can issue shares at any price you like. But banks are very reluctant to do this, to dilute existing shareholders when the shares are trading in the market at significant discounts to book value. I mean, that bit is quite simple. When we look at falling markets, the situation is actually quite complex, because I've just been talking about, in the main anyway, about bonds. Bond yields rising, bond yield prices fall. In the Eurozone, the ECB has probably lost in the region of about 25 to 30% so far on its enormous holdings. When it comes to equities and also bonds in the commercial banking network, they use other methods to hedge risk. And this is why you've got things like credit default swaps and you've got OTC options protecting you, so you can cap and collar, let us say, a position. There's all these sort of devices that help protect you from risk. If, let us say, the equity market falls another 20, 30%, then in theory anyway, banks don't necessarily fall over and die. I mean, they've got the problem that they will get non-performing loans because under those circumstances, I think you'll find that quite a lot of their borrowers will be in difficulty because they are essentially financial, things like hedge funds and so on and so forth. And they'll be forced into selling yet more stock into a falling market. But in theory, if they have taken out, if they've hedged their risk in the futures market or the forwards market, then they might feel that they are relatively well insulated. And I'm sure they'll make the returns to the central banks on that basis. But this assumes that your counterparties don't fail. If you have a failure in your counterparties...
Yeah, don't worry, I've got insurance. Oops, there goes the insurance, my counterparty.
Yeah, exactly. That's right. Now, the insurance isn't with AIG or someone like that. The insurance is with Deutsche Bank or BNP or one of those guys in the Eurozone, or perhaps the Japanese banks. And so you can see that suddenly all this protection isn't necessarily there. So, I mean, really what we're looking at, I think we're on the edge of a huge, great financial mess. That's the only way to describe it. And of course, everybody in the systems, they're not really looking at this. They're only looking at, what's going on in the market. Is it going up, down? What's the Fed going to do with interest rates this afternoon? Is it 0.75% or whatever? Who cares? The problem is far bigger than that. It really is. And you referred to the bounce in the bonds. I mean, to me, I would say that given the very sharp rise in bond yields in the last few days, to have a bit of a sort of clawback ahead of the announcement, which everybody's frightened of, makes sense because, I mean, people who will have shorted US Treasuries will be buying them back because they don't want to take the risk of losing a profit over the uncertainties of a Fed announcement. So I can see why it is that yields have, after rising very sharply, have come off. And I think, to my mind, that is a better explanation than someone with big boots has walked in and supported the market. I wouldn't rule that out. And I wouldn't rule the Exchange Stabilization Fund, which was set up in 1934, basically to manage the gold price, but it manages everything I think that it's told to manage. And it works out of the Fed's offices anyway, even though it's a Department of the Treasury. I can see them maybe intervening in these markets. That wouldn't surprise me at all. But on the face of it, I mean, what we're seeing is we're seeing a technical bounce ahead of an announcement. What happens there after that? I should think after a brief pause, I should think markets will continue on down because it does not address this fundamental problem that interest rates are so far adrift from the reality of the loss of purchasing power of currencies. And it's not just the dollar, it's them all. It's all of them. With the sole aggravating exception of the Russian ruble. But that's another story.
You've talked with us for years about the awakening that eventually will happen when enough people realize it's not just pointing your finger at the high gasoline prices or the high food prices or whatever. And that's all that's happening. When you look on the mainstream media, they're just giving example after example after example of specific items which have increasing nominal prices. Not in a single one of those stories, and I've seen dozens of those stories covered by supposedly professional journalists, has anyone uttered the destruction of the purchasing power of the currency or the actions of the central banks or the government to debase the currency, that sort of thing, so that people are just totally distracted by pointing to examples of high prices as though these things, and then, gasoline, oh, well, that's because of the Ukraine war or whatever, rather than this is absolutely unavoidable if you look at what's been going on for decades, perhaps a century or more, from these central banks. I have to give you an opportunity to weigh in on that, since that's been such a major theme that you've brought out, and now it's playing out, but it's still being touted in a distracting way as just look at this example, look at that example of high prices.
Yeah. Well, yes, you and I have been talking about this for years, and it's finally here. We know the causes, but if you try and explain it to the general public, they only understand what they see. They see the price of gas rising, and they think, it's either Ukraine or it's whatever, or it's greedy Exxon, or whoever they want to blame. And of course, the politicians pander to it. People like President Biden are talking complete nonsense. Now, whether they actually understand a little bit more than they're letting on, I couldn't possibly comment. But it is their job as a politician, unfortunately, to talk nonsense. And that's, they're very good at it.
Another example of that is blaming the people themselves. Oh, it's the wage price spiral. It's people demanding higher wages. People were demanding higher minimum wage. People were demanding raises, and that's what's driving inflation.
Yeah, you're absolutely right. It's that, or it's greedy capitalists, or it's the truckers, or it's it's the shipping companies. They shouldn't be charging so much. Yeah, they will blame anyone and everything, other than try and explain the real cause. And apart from anything else, the government has benefited from the transfer of wealth through debasing the currency. And it doesn't want to lose that benefit. If people actually understood what was going on, God knows what would happen. It would be a complete revolution. But they don't.
A very good point, and two more examples that should light people's blood on fire. And one is false capital gains taxes. The other is high increasing property taxes. At least in the U.S., the way it works is if you own something, anything, whether it's gold, silver, or anything, and it increases in nominal value, and you sell it for a higher nominal price than you bought it for, you owe tax on the difference of this supposed gain, which was absolutely engineered by this debasement of the currency. So it's basically saying this thing that you own, we get a cut of it. Why? Because we say so. It's just the government stealing directly from you. And secondly, if you so-called own your own home, the American dream has always been to own your own home. So you own your home. Really, try not paying your property tax. And as the comparative prices around you go up and up and up in your neighborhood, they revalue your home, and now you owe more and more and more property tax just for the privilege of owning this thing that you already supposedly owned.
It's the same everywhere. Governments are reluctant to index things. Not that indexing is something that can work anyway, but it at least gives some relief from the debasement of the currency. But as John Williams points out, soon after they started doing this in 1980, they found means to reduce the impact on government finances, which basically means that they found means of not compensating you for the debasement of the currency, as reflected in rising prices. And every adjustment that government makes to the method of calculating indexation is in their favor. So why people think, government is a good thing or whatever, it's completely beyond any logic. It really is. And we've got to the situation where government is far too expensive for the people to pay for it. And that is the reality. In this country, we have Boris Johnson, who was elected into office as a sort of pretty free marketeer type. And he is now turned into one of the most virulent statists you can imagine. The answer to anything is just chuck money at it. And he's sort of claiming that, we will only cut taxes when we can afford to do so. And he's been told that by the Treasury, because the Treasury is completely aware that if they have to run large deficits the whole time, it'll just undermine the currency, and interest rates would have to shoot up, and the currency will be debased. It's as simple as that. The Treasury knows this. What the Treasury will do is it'll turn around to the ministers and say, right, we need to have the revenue. The most important thing is to balance the books. And if you want to spend more money, then it's quite simple. You'll just have to raise more taxes. And that's what is now happening. And we cannot afford our government. And I would venture to suggest the same is true in America. It's certainly true all around Europe. I mean, think of the poor French. France. By the time they take in the sort of, not only the government, but it's sort of quasi-monopolies, which it sort of owns at arm's length and all the rest of it. Sort of manufacturing, the aerospace stuff and, the car manufacturers who are effectively, sort of in league with government. I mean, that's 72% roughly of France's GDP. I know officially it looks like it's about 60%, but actually it's well over 70%. What does that leave? I mean, it leaves the rest of the country in sort of as poor peasantry, and they're living almost as they've always lived. And this is part for us as visitors. This is the charm of France. You go into rural France, little town, and there is the market. And it's all a cash business. It's people growing things and selling them in the market for cash and all the rest of it. The operation of these auberge, these auberge, the inns and so on and so forth, that's all a family affair. Just keep it in the family. You don't pay anything out. You don't declare your taxes or anything like that. So they're living sort of almost on the breadline. And we think this is, it's just lovely to see the French. Isn't it wonderful to see how they live and all the rest of it? But my God, the attitude that comes with this is really quite terrifying. It means that all these people actually think it is wrong to make a profit. Yeah, they really do think that any businessman, and particularly a foreigner like a Brit, who sets up, say, in the Dordogne or something like that, sets up a business with a view to making a profit, is committing a sin. I mean, this is taking money from people, and so you got this sort of extraordinary mix of attitudes, which are just self-defeating, and when you get a collapse of the whole system, is basically, rub it out, start again. It is the market creating its own anarchy, if you like. That the only way in which this government can be ended is by the anarchy of the market. And that basically is what we're going to see. And it's going to be extremely uncomfortable for everyone, except the few people who've taken the wise route before the crisis of exiting the fiat currency world as much as they possibly can.
Alasdair, we're soberly observing that progression that you just described, concerned about where our places of our families and those that we love and care about and our beloved countrymen and our countries themselves will be through this process. If people want to stay connected to your weekly writings, where should they get plugged in?
Go to the Gold Money site, hit the Insights tab, or rather Research and then Insights, and I publish an article on Thursdays, sort of afternoon EST, and I do a market report on precious metals on the Friday as well. So that's the sum total of my contribution, I'm afraid, apart from the odd podcast with people like you.
Well, we're grateful for your presence always here on behalf of all of our viewers. We wait with bated breath between your visits here and are grateful to have you back as soon as we can. We've been speaking with Alasdair MacLeod, former bank president and head of research at goldmoney.com. Alasdair, as always, thanks for joining us on Liberty and Finance.
That's very much my pleasure. Thanks, DK.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.